Turn on financial television, and sooner or later somebody is drawing lines on a stock chart. A neckline here, a support level down there, a shoulder, a head, and another shoulder. The shape gets a name, the name gets a forecast, and there's a piece of mathematics underneath all of it. This whole video is about one question. What does it mean when a chart contains a pattern? It's the mathematics of searching, and it's more brutal than most people expect. So we're going to run a chartist's own detector on charts with no market behind them. Then we'll do the harder thing and test over 1,000 trading rules on pure noise. By the end, you'll have one question to ask anybody who ever shows you a chart. Let's start in 1959 with a University of Chicago statistician named Harry Roberts. Roberts built a year of a stock market out of a random number table. No companies, no earnings, no news. His chart contained the most famous shape in technical analysis, a head and shoulders. His words. Probably all the classical patterns of technical analysis can be generated artificially by a suitable roulette wheel. So let's define that shape properly. A head and shoulders is 5 turning points in a row. A peak, a dip, a higher peak, that's the head, another dip, and a final peak. The outer peaks sit roughly level. The line joining the two dips is the neckline, and chartists expect the trend to turn. Low, Mamesky and Wong made that precise. Both shoulders match within 1.5%, and so do the dips. 2 more words you'll hear. Support is a level the price keeps bouncing up from. Resistance is a level it keeps failing to break. And a trend line connects 3 or more turning points. Now the chart. We generated 2 years of daily prices from a random number generator. It drifts up at 10% a year, and it wobbles at 16% a year. Those 2 numbers come from the real American market. They're the only thing we borrowed. There's no company behind this, no economy, no buyers, no sellers, no information of any kind. And here's why that's such fertile ground. 2 years of daily prices holds about 51 turning points. Any 5 in a row could be a head and shoulders, so each chart gets nearly 50 attempts. 1 attempt is unlikely. 50 attempts across thousands of charts is not unlikely at all. So we built 4,000 of these charts and ran the detector over every single one. Before the numbers, a guess. Of 4,000 charts with no market behind them, how many held a named pattern? All 4,000 of them. 100% contained at least one named pattern. 4,645 head and shoulders, and another 4,643 upside down. 28,001 support and resistance levels. 97,209 trend lines, which brings us to the paper people reach for when they want to defend chart patterns. In the year 2000, Low, Mamesky, and Wang automated 10 classic patterns and tested them properly. 350 New York and American Stock Exchange stocks from 1962 to 1996. In that real market, their detector found 1,611 head and shoulders. And in the very same table, they ran that identical detector on simulated random prices. The same kind of series we just built. A drift, a wobble, and nothing else. Before I read you that column, guess. 0? A handful? 577 head and shoulders, in a market that never existed. The paper people cite in defense of chart reading printed that number in its own first table. Now, 2 honest caveats, because this argument has a sloppy version and I won't hand it to you. First, how many head and shoulders you find depends on how you define a turning point. Tighten that window, and 99.2% of these charts hold a head and shoulders right way up or upside down. Loosen it, and that falls to 46.1%. The setting moves the answer. But at every setting we tried, essentially every chart still held a named pattern. It doesn't rest on one shape. Second, and this matters more, noise and real markets don't make these shapes at the same rate. Real prices gave that team about 2.8 times more head and shoulders than the simulation did. But turn to the broadening top, another named pattern in that same table. The simulated data produced 1,227. The real market, 725. More of that pattern in the market that didn't exist than in the one that did. So the claim isn't about rates, it's about presence, and presence is cheap. So why does a shape on a chart feel like evidence? because of how you look for it. You don't test one hypothesis. You scan the whole chart for anything you recognize. That's a search. And nobody, including you, keeps count of the shapes that got rejected. A hit feels like a discovery. It's really the survivor of hundreds of silent misses. That's a genuine statistical problem, and it has a name. Multiple testing. But first, a concession, and it cuts against me. You'll often hear that nobody can tell a real price chart from a random one. That's false. Andrew Lo ran the experiment, and people were clearly able to do it. 78 subjects, just over 8,000 guesses, across 8 different datasets. On every one, the odds of scoring that well by luck alone came in under 1%. And finance professionals were no better. 73.6% correct, against 72.2% for everyone else. But look at the task, because it isn't the task a chartist performs. Each fake was the real returns shuffled into a new order. Same average, same size of moves, different sequence. 2 charts side by side, pick one, and you're told the answer after every single guess. What people learned to spot was texture. Real markets have quiet stretches and violent stretches. That's volatility clustering. It tells you about risk, and nothing at all about direction. They could tell the real one from the fake one. It still wouldn't say what happens next. But the seeing problem is the small problem. The testing problem is worse. So let's run the honest test. Not eyeballing shapes. Rules with numbers attached. First, one piece of vocabulary. The Sharpe ratio is a strategy's return divided by how much it bounced around. Reward per unit of wobble. Higher is better, and in the paper we're about to meet, 1 is the bar. Now, 4 mathematicians, Bailey, Borwein, Lopez de Prado, and Zhu, asked a cruel question. Suppose you test 10 strategies, and every single one of them is genuinely worthless. What's the best Sharpe ratio you should expect to see anyway, purely from luck? 1.57 from a single year of data. 10 tries on data with no signal at all. Add 7 on-off switches to a strategy, and that's 128 tries and a best Sharpe above 2.6. And they turn that into a rule. With 5 years of data, you get about 45 independent tries. Spend more than that, and a Sharpe of 1 has stopped meaning anything. So we ran it, not on a market, on a random walk with no drift at all. No upward trend, so nothing in the data can be mistaken for skill. 10 years of it. Then a family of moving average rules. The plainest strategy in the book. When the fast average crosses above the slow one, you're in. When it crosses below, you're out, or short. 13 choices for the fast average, 13 for the slow, 4 buffer bands, and those 2 modes. 15 of those pairings are invalid, so 154 survive. That makes 1,232 rules. We fit all of them on the first 5 years, kept the single best, then ran it on the next 5. Here's one run, and it's the median out of 1,000. Deliberately typical, not the best we found. On this one noise series, 776 of the rules made money in the first half. The winner was a 10-day against 25-day crossover with a 1% buffer. Sharpe of 0.77, up 58.4% over 5 years. That's a chart you would put in a newsletter. Smooth, profitable, and completely fictional. So what does it do in the next 5 years? Same series, same rule, no changes. A Sharpe of negative 0.87. It gave back 36.3%. And that's one path. Run the whole experiment 1,000 times over. The best Sharpe in that first 5-year half, the in-sample half, averages 0.793. That same winner's Sharpe in the second half, out of sample, averages negative 0.039. Call it 0. And more than half of the winners came out negative. Now here's the number I'd put on every research desk in the world. The correlation between a rule's in-sample Sharpe and its out-of-sample Sharpe was 0.036. Not a weak predictor of the future. Not a predictor at all. The in-sample number was measuring how hard we searched. It was measuring nothing else. And those winners look statistically significant, which is the cruelest part. The conventional bar in finance is a t-statistic above 2, and 33.9% of ours cleared it. Harvey, Liu, and Zhu counted 316 published factors, and argued the bar should be 3. On pure noise, 4.8% of our winners cleared 3 as well. One honest note on our own experiment. Those 1,200 rules overlap heavily with each other. They behaved like roughly 15 truly independent tries over 5 years. Which is why the damage isn't bigger. So is all of this astrology? No. And I'm not going to pretend it is. Park and Irwin surveyed 95 modern studies of technical trading. 56 positive, 20 negative, 19 mixed. Low, Mamaisky, and Wang concluded that several technical indicators do provide incremental information and may have some practical value. Their own limit on that matters just as much. That doesn't necessarily imply you can generate excess trading profits. Now look at what happens when somebody searches properly and reports it. Hsu and Kuan tested 39,832 rules across 4 American indices. They found genuinely significant winners for the NASDAQ and the Russell 2000 in the 1990s. For the Dow and the S&P 500, nothing significant at all. Their assumed cost was 0.05% a trade. In their words, underestimated for non-floor traders. Their NASDAQ winner then lost 32.4% in 2002, though buy and hold lost more. The longest version of this test ran the Dow from 1897 to 2011. Bajgrovich and Skyeth found that an investor could never have selected the future best-performing rules in advance, and even low transaction costs completely offset whatever performance was left. Now the fair counterweight. One price-only signal really has survived, and it isn't a shape. Momentum. Buy what's been rising, sell what's been falling, and hold for a few months. From 1965 through 1989, Jagadish and Titman measured 12.01% a year. 9.29% after costs. It kept working out of sample through the 90s, unlike size and value. But since publication, the standard momentum factor has run 5.33% a year, T-statistic 1.88. Since 2009, 0.18% a year. Weaker, not dead, and never readable off a shape. You own a portfolio, and other people show you charts. Here's what that habit actually costs. Barber and Odean tracked 66,000 households at a discount broker for 6 years. Before costs, the busiest traders picked stocks about as well as the calmest ones. Between 18.5 and 18.7% across every level of turnover. After costs, the busiest fifth of them earned 11.4% a year. The market returned 17.9%. The gap was trading, not judgment. And commission-free isn't free. Measured round-trip costs at 5 American brokers ran up to 0.46%. So what actually survives? For somebody who holds a portfolio for 20 years. Over the 20 years to the end of 2025, the S&P 500 returned 11% a year. Active large-cap funds returned 9.62%, weighted by the dollars actually in them. 1.38 percentage points a year, handed over for the privilege of being managed. Meanwhile, the average dollar in an American fund now pays 0.32% a year. In index funds, 0.1%. That part you control completely. So here's the one idea I'd keep out of all of this. A pattern on a chart isn't evidence, because charts with nothing behind them are already full of patterns. And a backtest isn't evidence either, unless you know how many backtests were run. Bailey and his co-authors put it plainly enough. Without the number of trials, you cannot judge the overfitting. That missing number is the whole game, and it's almost never on the screen. So the next time somebody draws a neckline and tells you what happens next, ask one thing. How many charts did you look at before you showed me this one? If this changed how you read a chart, that's the kind of thing we'll keep building.